Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Wholesale Energy Markets, Gas and Electricity Shaken by the Virus. We are very grateful to Jean-Michel Glachant from the Florence School of Regulation and our distinguished panelists for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services that you can find at our website, www.iaee.org. If you are not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have any questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We kindly ask that you do not send your questions by email. We've allocated sufficient time at the end of the webinar to answer your questions. And now I'd like to introduce you to our moderator, Jean-Michel Glachant, Director, Florence School of Regulation. Jean-Michel, over to you.
Many thanks, Dave. Ladies, gentlemen, good morning in the US, good afternoon in the EU, good evening in Asia. I am both Vice President at IAEE and Director of a European school, a school for European energy regulation. So that's really my interest in life. You all know that we are living this coronavirus world crisis, and these days, it's mainly on the shoulders of a few Western countries. Yesterday, it was said that 100,000 people are dead in a handful of countries, Italy, Spain, France, UK, and North America. But it's not this human, terrible aspect that we would like to discuss. It's the economic crisis going with. IMF said in its last review that it's the worst crisis ever seen by humans since the World War II, and was forecasting for the US a crisis of -6 points of GDP, for the EU -8 points of GDP. This morning, the Wall Street Journal was saying that roughly 22 million of American workers are jobless. In my country, France, a third of the private sector employees are jobless, including 2 of my kids. And we would like to discuss this economic crisis and the wholesale markets for gas and electricity. We are going to look at EU and the US. And for that, we have 4 outstanding experts, 2 from EU, 2 from the US, 2 for gas, 2 for electricity. The first one to speak will be Emmanuel Clair. Emmanuel has already 20 years of experience as power trader and is currently with R3 Partners in London. Next speaker for Gas EU will be Walter Bolz. Walter Bolz has been for 15 years the head of energy regulation in Austria and also vice president of European energy regulators, looking particularly at gas. Today, he's still member of the Board of Appeal of the European Agency for Energy Regulation and member of the advisory board of EPRI in the US. Next speaker, again, a reference in this area, Jeff Makholm. Jeff is managing director at NERA. He's in the business since several decades, and he's also well known in the EU, particularly for his fantastic book on gas regulation. And we will end by the youngest, but look at Max. Max doesn't look like a kid. He's the youngest because we are older. And Max has a very good CV. Also, he's coming from MIT. It's not an accident because Paul Joskau was happy to be with us today, but has been taken back at the last minute by a board meeting he cannot bypass. And Max has been gentle to join us last minute to take the electricity side of the discussion in the US. We are going to start. We will give about 20 minutes to the panelists. Then the panelists and me, we will discuss for about 50 minutes. And then we will go for the audience 20 minutes. But please ask questions, because I cannot imagine what you think, the audience. I know that you are from India to North America, Latin America, but I cannot expect what you would like to discuss. I'm jumping on Emmanuel Clair. Emmanuel, the way I see the beginning is like this. We have an enormous reduction of demand for electricity in Europe, sometimes 15%, sometimes 20% less demand. If mail order works, we will have a different set of generators able to produce, then the prices will move. We have also the renewables, it will interact. Then we will have consequences of this reduction of demand and different prices. But will these consequences be mainly short-term for some months, or with other longer-term consequences, like 1 year or 2 years? I do not know. You will tell us, because it is your job, Emmanuel.
Yeah, thank you, Jean-Michel. So my job is to know that sometimes we don't really know. For instance, I would have said something very different yesterday from today. For instance, the news today, a very fresh news, was that French nuclear generation this year is supposed to drop quite significantly by maybe 60 or 70 terawatt-hours. We're talking a little bit more than 10 gigawatts of drop in supply from nuclear generation in France. This is just from today, so it just shows that things can change very fast. But let's talk about the short term, the first impact that we saw. So, as you said, the first thing was a significant drop in power demand. It started in Italy when the first confinement measure started in 21st of February, but it took more than 2 weeks to really have an impact. On the 2-3 days later, we saw a little bit of drop in demand of 2-3%, and it bounced back to nearly unchanged. Only on the 9th of March, then we really had the big bulk of drop of demand by now 25%. Other countries in Europe with very strict lockdowns, like France and Spain, experienced at the time as well drops of around 20%. Countries with slightly easier rules, like United Kingdom, it's only 12%. In Germany, it's definitely less than 10%, so we think. And in Nordic countries, where the confinement measures are much less, it's even hard to tell if there's a significant drop in demand. Obviously, it made power prices drop. It was a chain. Power prices are made up because gas is at the margin in most countries very often. Gas prices had come off maybe 20 or 30% versus where they would have been. They were already quite cheap. The carbon price in Europe dropped by 20% before bouncing back, dropping and bouncing back again today, probably on the news about the French fleet. All that made, with the drop in demand, power prices dropped by as much as 70%, and we had on Easter Monday a spate of negative prices in most countries of continental Europe, of northern continental Europe. So, big impact, but as I mentioned to start, it may affect the generation over time for a few months, maybe a few years of nuclear power. So instead of making prices come off, it may then go up. Who knows? For me, all in all, the two events are a glimpse into the future. What happens when we have a very decarbonized market? Because what we have at the time in April in Europe is there is very little gas being burned for power and next to no coal. I'm talking especially Western Europe. See, Germany and Poland are slightly different. Prices are too low. You cannot have prices around 0, 10, 20 euros to justify any investment. They don't represent the true economic cost. It's just the short-term marginal cost. Shows something. In a decarbonized market, your marginal cost is close to 0 because be it nuclear, wind, hydro, or solar, the marginal cost is close to 0. It's definitely not a normal market price. And then at the same time, we could see with the penetration, because that could be, by the way, the aim of having a decarbonized market in system in Europe, well, that's not sustainable, in my opinion, in the current rules. You need to reward a bit differently. There are a few years to do that, but it has to be thought about. Then there was some other issues that we saw is some credit issues. I started my career and very soon afterwards, everyone went under. So I got used to what the normal for me was defaults. We started to see in Asia force majeure being declared on LNG cargoes. That happens, but maybe a few more than usual. But then what we saw in Europe, it became acceptable not to pay your bills. Some people simply cannot pay the bills, but it creates a precedent that, okay, I'll pay you in 3 or 4 months. It's fully understandable, but that creates a problem of how you manage money, how you manage contract. And then some attacks on contracts who I think, I'm not a lawyer, but strange attacks, especially in France, against good contracts, I think, on nuclear energy by the French incumbent. So those are kind of troubling. My experience is that that type of credit issues, the market is able to digest them, but it only goes one way. Then again, a glimpse into the future, an acceleration of time, well, credit will be even tighter and tighter, which creates other issues. Tighter credits, tighter rules means financing a few things becomes more difficult. Dealing long-term becomes difficult. There was a time, my first foray in energy was dealing with contracts that would last 50 years. A few years later, people were only dealing 2-3 years. That's a problem. When you tighten the credit, people trade shorter term. So another issue that we may see that would be more mid-term, long-term is how do we finance renewables? Until a few months ago, it was pretty easy to finance large assets of wind or solar. There was a lot of money available at 1-2% for 20 years. So you could take that money and finance your renewables. Now, will that money be available?
You have to conclude, Emmanuel.
Yeah. Now the other problem is how do we use expertise? There was some signs maybe that the COVID-19 was not just a flu. Now the issue is sometimes there are things that could look a bit obvious that are put under the carpet. What happens when you have so many renewables put in place? Well, some people would say power has to go up, power prices have to go up. Well, it's not sure. Maybe it comes off. Or when you keep drilling to get gas and get LNG, you should not claim, oh, gas price, there's a shortage of gas. So using common sense alongside expertise would be my message.
Thank you, Emmanuel. So you are moving the pillars. Huh? I had volume, then price effects, and you want to add risks. Very interesting. But now we are jumping to gas with Walter. Walter, is the situation in gas coming from the power sector, or do we have a particular dynamic in gas for the European industry? Walter?
Yes, hello. Sorry, I had to unmute. I hope you can see my slides. I just have 3 slides to show. And basically, I think we have seen that the energy markets in Europe are really also seriously infected, not only the population, and we are far away from any recovery on the gas side. We have to acknowledge that the European energy prices in general were already some time ago going downwards. So it's not a trend that only started with the coronavirus, because we had zero-cost renewable electricity stored in markets. We have already since some time an oversupply of LNG, and we have a continuously declining gas demand since 2007, 2008. So there were some tendencies to go down, but on top of that, we have in Europe, as there was a discussion about the Ukrainian transit at the end of last year, an extremely well-supplied storage sector. So we have a lot of gas in storage because people were counting on a potential disruption, which never happened, fortunately. So we have just too much gas in Europe. And when the pandemic came, it accelerated those developments. We are seeing a most likely global long-term gas demand destruction. It will be interesting to see how big it is, but it will be substantial. we are likely going to have a long-term LNG oversupply, an oversupply capacity of import capacity in pipelines into Europe. We have currently an almost unprecedented level of almost 60% of storage, gas storage is full at the middle of April. Normally they're like 25% full. And of course, because of the reduction in demand, and that's between, let's say, 10 and up to 25, 30% not demand reduction, we see an increasing competition amongst the oversupplied shippers. And of course, there's some general trends, somewhat pressure to move away from all fossil fuels, including gas, and then efficiency, reducing gas demand in many sectors. So we have now a situation where gas prices dropped massively from, let's say, 17, 18 euros per megawatt hour to 6.50 to 7 euros per megawatt hour. So by 2/3, more or less, over the last few months. And development. I believe that the pandemic and the recession that we are for sure having in whatever size or scope will change the political priorities, at least in Europe and probably also globally. We will see that climate change initiatives will be allowed a longer period to materialize. The importance of costs, added costs because of policy measures, will be increased a lot. And we will see a fuel price competition that is likely to change the way energy, fossil energy is used. I also see a medium-term decrease in ETS prices, although not as much, because the market stability reserve will probably mean a certain amount of gas of EU certificates will be taken out of the market. Of course, the interesting question is, will this reduction in gas prices push out coal and oil sooner as we thought? And how will it affect the speed of the decarbonization efforts? I don't think decarbonization efforts will stop, but it will probably be a much slower path. And even yesterday, the Czech president said, well, let's reconsider if we really want to go to decarbonization. It costs so much money. We have other priorities. So for a gas specific, there could be a possibility that dark spreads might basically disappear. So it might be without added cost if you switch from coal to gas, even at relatively modest CO2 prices. And I think it is important that the decarbonization timetable is adjusted in a way to take account of the different priorities. Now, this is, of course, bad news, but not for everybody. For consumers, low prices are actually good news, especially in light of reduction of free money to spend. For producers, it's more critical. For the industry, the energy industry itself, I think there are some time has been given to the industry to do some things right, and with a little bit time to avoid problems that we could have had if we were jumping head on into decarbonization.
To conclude, Walter.
I have 20 seconds. I think decarbonization measures could be better planned and prepared. We could focus more on methane emission prevention. I think there is room for thinking through how sector coupling is properly working, and overall cost and cost for consumers will matter more than ever. So I think this has started a structural change in the gas sector, which will not be over once the corona crisis is over and the economy starts to pick up a little bit. I think it will massively affect the gas sector for many years to come. Thank you very much.
Thank you, Walter. So you're really adding a new vision. Huh? You are saying, well, okay, the crisis is accelerating the path because gas was already on a trajectory in the EU, but this crisis is so big that it will change something. It's impossible that we get out of the crisis with the same landscape. So we will see. Now we are jumping to the US. I'm not very familiar with the details of the US, but I assume that the US gas is mainly driven by what happens in the US and not not at all by the EU, but this we will see from Jeff. Jeff, US gas, what are the drivers? What is happening?
Thank you, David, and my friend Jean-Michel for facilitating cross-Atlantic discussions in energy markets. People on both sides rarely get a chance to talk, especially now. Regarding U.S. gas wholesale, it may seem counterintuitive, maybe paradoxical, but COVID-19 has had no great effect on wholesale gas markets here. Part of that is just a function of history, but mostly it's because the gas market in the United States is generically different than that in the EU. Let me explain. 85 years ago, in the most muscular intervention ever into the nature of US business practices, Congress broke up all multi-state energy utilities and forced gas businesses to be regulated solely by the states. That remains true today. The federal government doesn't even collect data on local gas utilities, having no jurisdiction there. Those local gas distributors have gone through changes. For example, when gas prices spiked in the $8 to $10 range per MMBTU in 2007 to 2009, when domestic production was declining and oil prices were high, usage declined and state gas distributors moved largely to decouple local charges from usage levels. Mostly since gas distribution is a pretty boring business. They purchase gas, arrange for transport, and give it to their consumers. Summer, winter, boom, busts, inflation, whatever, they collect their permissible revenues come what may. The excitement in America in the meantime has come at the wholesale gas production and transportation level. Who pulls gas out of the ground and who transports it? The changes in transport came first. In the US, once we had a fully regulated wholesale merchant business run by the interstate pipelines. And as a nation, we were terrible at it. That kind of organization of the wholesale market was bad, mostly after the 1973 OPEC oil embargo, when interstate shipments were interrupted and consumers lost billions of dollars in consumer surplus. The entirety of the 1980s and 90s in the US were devoted politically to getting interstate pipelines out of the gas business, merely to become transporters for hire. And it worked beyond all expectation. US interstate gas pipeline companies represent almost 70% of the world's major gas pipelines. But the FERC gas division has only 250 employees to oversee the whole thing. But if the pipelines were out of the gas business, what about wholesale supply? The greatest difference between Europe and the US is that you had Napoleon and we didn't. In America, the farmer owns the gas. In Europe, Napoleon expropriated the subsurface mineral rights for the state, concentrating mineral ownership at the national level. In the US, every farmer is a potential gas producer with no state interest in sight. The high gas prices in 2007 to 9, that $8 to $10 business, funded a new technology, fracking, that now produces most of our gas. The wholesale price of gas in America is driven by that technology, which continues to advance. For the most part, it is not a transport fuel. And the prices have not changed in any significant way since the spat between Putin and MBS, or the virus. So all in all, that is, as Walter had explained, gas prices have dropped by 2/3. Oil prices have dropped by 2/3 since the beginning of the year. And gas prices in America have dropped 5%. Only 5% since January. Basically nothing. So all in all, having no connection to oil markets, not a major transport fuel, a robust increase in gas use because the prices, with essentially no regulatory involvement at the federal level in any way. What we see from January to now in the gas use and the gas market in the US, from the farmers to the gas-fueled streetlights in Beacon Hill where I live, or my gas stove, very little has happened. Over to you, Jean-Michel.
It's always surprising for a European. We think that we know the US because we love you, we are friends, but from one industry to the other, we absolutely do not know what is happening. And maybe the same will arrive with electricity. So Max will tell us. The only prejudice I can have about electricity in the US is to think that it is a state affair. So the same will not happen in Texas, in Pennsylvania, and New England. But up to you to tell us, Max, do you have a volume shock regarding demand for electricity? Do you have price shocks? Is it mainly local? Is it more regional? Or do you even have something national with electricity and coronavirus crisis? Max, up to you.
Thank you, Jean-Michel. Regarding the US electricity industry, COVID-19 has been only modestly disruptive compared to other sectors of the economy. Moody's and other credit rating agencies, for instance, expect creditworthiness of regulated electricity companies to be less impacted than most of the other sectors that those credit rating agencies analyze. The largest of those disruptive impacts in the electricity industry do not have to do with the operation of power markets or the reliability of the bulk power system. The largest of those impacts, rather, have to do with rate recovery and financial challenges that face regulated electricity companies, as well as disruptions to the supply chains of power producers and regulated companies. Given my limited time, I will discuss just one of those impacts, the impact on rate recovery for regulated companies, after summarizing the impacts on electricity demand. All 7 regional electricity markets in the US report year-over-year declines in peak and/or total electricity demand. For recent weeks in March or April, those markets report declines in peak demand from about 1% to about 8%, and declines in total electricity demand from about 3% to about 8%. The Federal Energy Information Administration expects US-wide declines in electricity relative to its previous forecasts as a result of shelter-in-place orders and an expected sustained economic downturn. The implications are significant for regulated electricity companies in the US. The provision and delivery of electricity is mostly a fixed cost enterprise, and most regulated companies in the US rely, at least in part, on per kilowatt hour rates to recover the revenue associated with those fixed costs. Moreover, most companies set revenues and budgets based on a typical operating year. No regulator or company would have foreseen before November 2019 or so COVID-19 related declines in electricity demand. And as such, company revenues in 2020 and possibly beyond may be woefully short of what is required to cover the costs of those companies. Exacerbating the challenge of under-recovery, some 20 US states have imposed mandatory prohibitions on service disconnection, increasing the uncollectible balances for regulated companies. State regulators have imposed such prohibitions to protect vulnerable customers from having their power service shut off at this critical time. For certain states, for some or all regulated electricity companies in those states, regulatory mechanisms are in place that decouple company revenues from electricity sales volumes. Such mechanisms may allow some companies to begin addressing cost recovery impacts on an expedited basis. But those cases are few compared to most cases in which such mechanisms do not exist. In those majority of cases, other regulatory measures will be necessary for regulated companies to recover costs. Such measures include disaster riders or surcharges, which have been used in the past to address short-term cost and revenue anomalies. In summary, while the US electricity industry is impacted by COVID-19, those impacts are modest relative to many other sectors of the US economy. Moreover, those impacts have little to do directly with electricity markets. Rather, The largest impacts relate to financial challenges faced by regulated electricity companies. Dealing with those challenges in the months and years to come will be the focus of much regulatory work in the United States.
Thank you, Max. I'm surprised again, you are speaking literally like a traditional French. Regulated companies, vulnerable customers, regulators. Why not? Because you are telling what is happening in your country, and this crisis can trigger many different changes. But I will do you a trick. I will come back to Emmanuel, and I will ask Emmanuel to comment what you said about the US electricity perspective. Emmanuel, are you lost, or do you feel familiar with what Max just said?
Well, the thing is, I cheated a little bit in the way that my company is half in the US and half in Europe. So I was reasonably aware, not about the payments, but that it has puzzled us that the drop in demand in Europe was way bigger than in the US. Trying to find ideas with my colleagues in the US. To be honest, we didn't really understand why demand had dropped so much in France, Italy, and Spain, and in many ways so little in the US. It's hard to tell. So energy savings done differently, and maybe industry particularly hit in some Mediterranean countries. What was very interesting is when Max said is that the idea, I expressed that not in a legal terms, but there's a big point on credit, the fact that you don't have to pay your invoices immediately. As much as it's perfectly understandable at a retail level and some small companies, I think that this system of you don't have to pay has been abused in some cases. So one thing the regulator will have to do is make sure that you don't have a bad payer just because he doesn't want to pay. Another lesson that I learned very early in my days of trading was that credit is everywhere, but not only credit is everywhere, but the first element of credit is willingness to pay. If you start having customers who don't want to pay even though they could pay, that creates a vicious circle. That can be addressed by, you want to deal with me, you'll have to prepay. So all the notion in commodity, where usually in physical commodity, I deliver and you pay me the following month, say the 20th of the following month, that has been used more or less forever, could be challenged. But then again, you can address credit, but it becomes expensive and cumbersome. But if we start having a spate of customers that are not very good credit for many reasons, some of them perfectly acceptable, that will have to change. But I've seen the tightening of the credit and the fact that people are really aware of make sure your customers pay. And seems to be really the point in the US. And in Europe, it seems to be the same.
We'll give the floor back to Max, 1 minute. Max, how do you feel after these comments from Europe and Emmanuel?
Yes, well, it is interesting, the differences in the declines in demand in the US versus Europe. In the US, there are places, the Texas electricity market has seen virtually no declines in peak electricity demand year over year, based on a recent week. But it has seen modest declines in the morning hours. And then in other markets like PJM, which have some of the largest declines, the peak demand has declined by something like 8%, which is no more than a typical winter storm day. So the operational impacts on those power markets have been pretty modest. The main challenges for electricity market operators in the United States has been organizing the personnel that are required to run those markets. Some of the measures have been rather extreme. For example, in New York, the New York Independent System Operator has requested that control room operators actually live at the facility in the control room. So now you have a batch of control room operators in Albany, New York, living there, and they've been there for weeks. but the operation and the reliability of the system has remained intact to date, although there is much talk about how to maintain that, and it's an area of concern. But so far there have been no effects.
Thank you, Max. Very interesting. So now we are going back to Walter. Walter, surprised by the fact that US is mainly regulation and regulated, and we in the EU, we are mainly open wholesale markets reacting or overshooting?
Well, not surprised, since I'm on the EPRIS board of advisors. I know pretty much what's going on in the US as well. And obviously, the US is in some aspects very different, although the gas market is not that different. So there is a fairly deep and liquid gas wholesale market in the US. I think what we see in the US is that the prices have traditionally been much lower than European prices, basically since the shale gas revolution started. And so I believe the effects will be smaller, because you will faster get to the point where you have a price that is below actual production costs, and basically that will balance itself. Whereas in Europe, we had traditionally significantly higher gas prices. I mean, I think also what we have to consider is that the economic effects of the Corona crisis have not fully arrived in the US. And the fact that, I think was said, that PGM is down 8% shows that areas which have been heavily affected, like New York, you see a bigger effect, whereas the Midwest and Central America probably have not yet been that massively affected. But it might change.
Walter, Jeff?
Okay, well, this is supposed to be a debate. So let me do something that is akin to debate. As I described, the gas costs in the US in the market are driven by high-tech extraction of fracked fuel. And gas, the original companies who produced the technology were driven out of business by their successors who had lower costs. But as I said, the technology continues to advance. And there's no possibility that gas prices can rise to the $2, $3, $4, $5 level, even half of what it was at $10 in 2007 to 2009. It is a wholly different business, unconnected to oil. It does not have much further to drop, but the effects in America of the virus are here. They're extreme. The social distancing, even though not directed at the federal, our irresponsible federal level, are affecting the lives of everybody in the major cities, particularly on the coast. And I don't think there's much left to see with respect to the demand for gas, and I don't expect the price to fall further. With respect to the fuel for power, gas will continue to be low cost, but generally, because it's such a highly competitive fuel, and because there is free entry throughout the country, every farmer in Oklahoma or Pennsylvania or Ohio, prior to the business generated by generally the mid-level to small-level oil companies. That's an equilibrium that we've seen, and we don't expect it to move except downward as the technology continues.
Thank you, Jeff. As we say in Europe, Vox Populi, Vox Dei. So the voice of the people is the voice of God. Huh? We are putting it this way in Latin. So we go to the people, and the first one to ask question is Burak. Burak is asking, how will market operators manage the changing debts and liabilities balance of the market players in the spot markets? I assume electricity. Are you expecting tightening or loosening policy of collateral mechanisms in spot markets? Who wants to address this?
I can opine briefly on the US perspective. In the US, there have been very few new market rules imposed by the various regional market operators in those jurisdictions. The only measures that those market operators have imposed have to do with the social distancing of personnel and ensuring that the personnel required to perform the critical services related to the functioning of the market and the system remain active. At the federal level, there has been a loosening of regulations imposed on those market operators in terms of reporting requirements that the purpose of that is simply to ease the burden on the market operators, ease the burden on personnel requirements. To date, we've seen no changes to spot market rules. On the other hand, of course, we have seen depressed prices, which has exacerbated the driving out, particularly coal generators and other generators at the margin. So we do see coronavirus having an impact, an impact which has began long ago, really, in 2007, 2008, when gas started getting much cheaper, and we see this exacerbating coal being edged out of the markets, and a continued decline of coal. And most recently, a large coal company in the US, Murray Energy, is facing liquidation. And part of that has to do with these further declines in marginal electricity prices. But that is a trend that predates coronavirus.
Thank you, Max. Next question, Emmanuel. So that's to you, Emmanuel. How do you assess the credit crunch? By when? Question from Jean.
For me, the credit crunch, it started, as I mentioned, I've only seen over the last 20 years, credit conditions tightening. So it became, so to give you an idea of the Enron bankruptcy was such a cultural shock in Europe. Until then, so until December 2001, most small utilities didn't even care about credit. They cared about being paid by their retail customers. They never really cared about being paid by the other utility. That's why they would sign very long-term trades. They were very well capitalized. That was a shock, so people started to think about credit. I lived through Lehman Brothers collapse in September 2008. Same thing, a lot of institutions had not thought about valuing credit. And every time, and nearly every year, I see people asking questions about credit, better and better. So I think this is just an acceleration of time of how people will realize, but I'm happy to deliver you electricity or whatever commodity, but I want to make sure that you pay me. And there are different ways. So the way that is a bit damaging to deal with credit is shortening the horizon of the trade. Instead of having a 20-year trade or 50-year trade as it used to be, you have only a 1-year trade, which is now kind of standard, 1, 2, 3 years. Many companies don't allow trading the notion of a contract beyond 3 years, which is a problem to hedge. Because then the problem is tightening the credit is good, but it prevents long-term hedging. The pity is that we started to see the emergence of hedging over 7 to 10 years of renewable projects, starting to have instruments on exchanges for especially German power or Spanish power that may still be there, but people will have to reassess credit. Another thing that when you talk to a person really specialized in credit valuation, when they show you the theoretical charge, it's usually mind-boggling. It's way above what intuitively you would think. So the problem is if you just think, oh, I really want to make my customer pay for the credit, well, you don't deal. So you have to find the thing is, yeah, okay, my customer may not be that able to deal, but or to trade or to pay me, but at some stage he will. So that's something. So I don't know how it will evolve. I think people are just going to be much more careful, and we could have the emergence of 2 different prices. Very good credit.
Thank you, Emmanuel. Thank you, Emmanuel. Next question is from Michael. Michael, it's a question, but a disagreement too. But Michael is saying, no, zero cost renewable are not the reason for price declines in the past few years. this decline was pushed by overcapacity and lower natural gas price. Renewables never set prices. Who wants to address it? Walter, Max?
Yeah, I think I mentioned that. Well, I mean, the zero priced renewables, of course, pushed the curve over to the right, and therefore the market clearing price became lower. So they did not directly sort of set the price by being there, by having renewable electricity generation that has a must-run condition. It pushed the prices to the side because they get the money not for selling electricity at a market price, but for just existing. And that's basically the fact with all or most feed-in tariff systems. And that's one of the reasons why the European Union now changed the rules for new renewables, as this is not workable if it's a large percentage. So technically, of course, it was not the renewable generation itself, but the fact that it existed, it increased capacity in many hours of the day. And that, of course, has reduced prices. And we have seen in the last, like over Easter weekend, unprecedented negative prices in many markets, down to minus 50 euros per megawatt hour for not like 1 hour, but for prolonged periods of time over Easter Sunday, Easter Monday, because there is so much more renewable capacity there. We have some must-run, nuclear mostly, and some very large coal-fired plants that would exceeded the demand that is very depressed at the moment.
Thank you, Walter. Now we have a remark and a question from Georg. He's saying, we all see decline in the prices for real estate. True. And now, how potential investors in energy efficiency for buildings will find any support from financial institutions? Good question. Who wants to address it?
I mean, I can answer that for Europe. I think
Walter answering Georg.
Yeah, I think in Europe, in many countries, there are separate goals for efficiency improvement, which are kind of independent of energy prices. So this market will be sustainable, and it doesn't matter if electricity costs 10 euros per megawatt hour or 100 euros per megawatt hour, because the electricity seller has a legal obligation to provide a certain amount of energy efficiency improvements and demonstrate that to some state authority. And if it doesn't do that, he gets to pay a fine. So this is a separate market. This market will not be affected. Of course, there's another market of people who are, on a voluntary basis, making investment to improve energy efficiency. And surely that market will be affected. And that's in industry, but also in real estate, in new buildings or in building renovation. So we will see some decline, but it will not be so big because a large part of the efficiency market is detached from energy prices.
Thank you, Walter.
You can comment on the U.S. perspective if that's helpful.
Okay, you have 1 minute.
Just very quickly. In the U.S., at least 20 states have actually stopped energy efficiency retrofit programs under the federal low-income weatherization assistance program, and remaining states have left decisions up to local coordinators, some of whom have also stopped work. And electricity companies, distributors across the country, have halted their own programs as well. And that's a big hit because the energy efficiency sector employs some 2.4 million people in the United States. So there has already been quite a large impact on that sector.
Thank you, Max. We have now a question from Trinat. Trinat is saying, what will happen to initiatives of low carbon pathways now that we know that so many countries will be badly affected, as IMF told 2 days ago? Any people willing to address that? Do you know the rules of it?
Yeah, I don't. Yeah,
Emmanuel.
this is a point that I addressed very briefly. It's you can have doubts about the feasibility now, or not the feasibility, but the financing of very large installations if the money is scarce. That's it. So probably the new facilities that were just about profitable may not be built, but you would imagine that some renewables, not only they did not need subsidies, but they were way better than the short-run marginal cost. When you had solar power at 15 euros or even $15 per megawatt hour, and in Europe it is extremely competitive in the south of so Spain, Portugal, parts of Italy probably, or I would say in India. Now, will we find the billions for that? Maybe not. Maybe it's going to take a little bit more time. But it is possible, maybe likely, that the project that were just on the cusp, maybe not exactly that profitable, may not come to fruition. I don't know. That's one of the worries.
Thank you, Emmanuel. A question from Nicolo to Jeff. Jeff, but nevertheless, you will have an impact on the US gas sector because in the coming months, many independent oil and gas producers will be affected. Jeff?
Oil producers, remember, oil and gas are totally different in the US. There is no world gas price. Gas price is set locally. There is a world oil price because it's so cheap to ship. Cost of shipping internationally for gas is twice the production cost in the United States, driven by high technology. The oil business in the US has been severely affected by the decline in oil prices. And many companies are going into Chapter 11 and going into bankruptcy. But the gas prices have been, by and large, unaffected. There will be some bankruptcies, but the industry already produced $2 gas for the past year. Now it's got $1.60 gas, $1.70 gas. It is not the sea change in prices that are causing the disruptions in the US oil sector. Oil and gas are different. They have different markets and their prices act different. So I expect to see a little bit of shakeout in gas, but most of the shakeout has occurred years ago as the first fracking companies like Chesapeake Energy left the business because they had high costs, yielding to those with lower costs.
Stay there because Rajesh, I assume from India, is asking how much gas demand reduction happened due to COVID in the US?
Is that a question for me, Jean-Michel?
Yeah, how much reduction of gas demand?
None. Gas demand is growing in the United States because the price is so cheap. Gas demand has displaced coal generation. Much of the American coal is heading to Europe on barges because we don't want it anymore.
Even in March and April?
Correct.
Okay. Then Max, power, reduction of demand in US.
Yes, so as I said, the peak demands have declined year over year by 1% at the lowest in Texas to 8% or so in New York and PJM. Total demands have decreased by 3% to 8%.
Thank you, Max. Now from Ronald. Ooh. The question is quite gas again, saying that we have announcement of cuts in capex for the shale gas. So will this move the price ahead? Will it move the price in the future?
I don't think it will. As I said, gas in the US divorced from oil years ago. And while there's great disruption in the oil industry in the United States and in Canada right now, the same kind of disruption is not felt in the gas production industry. Not the same level, a little bit, but nothing like the disruption in the oil industry in the United States.
Okay, yes, thank you. Oh, now we are going with Richard to electricity. And Richard is saying, the duck curve before the COVID crisis and within the COVID crisis, do we see different duck curves? Do we see variable renewables being more curtailed now? Or you don't see so much changes? Emmanuel, Max, Emmanuel first.
Yeah, but it had an impact because if you shift down, shift up, or shift down, I don't know how to call it, but if you remove 40 gigawatts of demand that was usually addressed by thermal plants, we had, it's more complex than the duck curve in Europe. A lot of it's addressed by nuclear cycling down in France, for instance. So sometimes the nuclear reactors have to cycle down. So as soon as you have prices that are very close to zero, yes, you have a duck curve, and we would not have had so many hours close to zero, below zero without COVID. So yes, for me, it explains a glimpse of the future. What happens if you keep putting a lot of renewables? Then you have a lot more decarbonization. So yeah, the duck curve was there, a little bit more pronounced, but it's not only duck curve because in Europe, very often you have excess in off-peak, so at night. So the excess was all the time.
So Max, any duck in the US?
Yeah, the most prominent duck curve in the United States is in California, which has the most solar in the country. And the load profile in California has remained basically the same, but it has shifted down. So the ramping requirements are about the same as they were prior to COVID. So the duck curve has remained largely the same. As well, California has had to increase its curtailments of intermittent renewable generation to deal with slight changes in the load curve relative to prior to the crisis.
Thank you, Max. We are back to the credit side. Ivan is saying, wow, the crisis is so big and the public finance now is going for hundreds of billions of credit. Will this change the rates? And if rates are going up in the future, will it change the whole economy and in particular hurt the energy sector? Any people willing to?
Well, let me start while the others gather their thoughts, Jean-Michel. There is no public finance in the US gas sector. All the companies are private, all the producers are private, and all the transporters are private. There are no public pipelines, no publicly owned gas distribution utilities of any note, and all the production is private. So the loss of public credit or the raise in the price of public credit, I do not see affecting the industry at all.
Pretty clear. We are jumping to another question, this time for Walter, and maybe it will be the last one, we'll see. Walter, is COVID crisis an opportunity for sector coupling, for the coupling of gas and electricity or gases in electricity? Is the EU policy?
Well, currently there is a lot of talk about sector coupling, but the readiness to do joint projects between electricity and gas companies is limited because in many countries, the electricity companies feel, they have the upper hand and, everything will go electric at the end. And so they don't want to spend time discussing with the gas industry. I think the slowdown in, support mechanisms to increase the renewable electricity production will probably allow some more time to develop business models that are sustainable with lower financial support and use the possibilities of a combined electricity and gas companies' approach to solving some problems. So I think it will basically allow time, and it will also make obvious that the electricity companies will not on their own be able to deliver everything. So I see some more possibility to develop common projects than we would have otherwise had.
Thank you, Walter. And we will end with a question to Jeff from Abdul Wahab. Abdul Wahab is saying, Jeff, I do not understand when you say that the gas market is not connected to the oil market. Abdul Wahab is assuming that most forms of energy so close correlate.
They do not correlate. I saw that question, and that assumption is wrong. They correlate when there's market power in pushing gas prices to equal oil prices. But there's no such remaining market power in the US, as gas is freely competitive in terms of the entry into the market. We have proven in the United States in the last decade that oil and gas serve different markets, and the prices are driven by different considerations. They do not correlate. They never had to correlate. They only correlated in the US by regulatory fiat or by the ability of those gas producers with market power to set their gas prices up to oil equivalents. But that power is gone. The market is competitive, and gas prices went from $8 to $10 to $2 as a result, when oil prices stayed high. That was the proof.
Thank you, Jeff. Thank you, Jeff. Thank you, Max. Thank you, Emmanuel. Thank you, Walter. Thanks to the audience, we had more than 200 people connected all over the world. It's unfortunate that we do this during this crisis. In certain countries, by Italy, France, North America, we really have the crisis and the dead people. In other countries, the pressure of death is little, but you will see the economic crisis, because as soon as you have Europe and the US in the crisis, this crisis is becoming immediately worldwide. I wish all of you to find a way to cross both the health crisis and the economic crisis. As you know, 2 of my kids are jobless, but fortunately for them, they are helped by the European policy. And I would like also to thank IAEE, the International Association. It's very strange for me to thank because I am vice president, but the idea is not coming from me to have this online debate. The idea is coming from our executive director, Dave Williams, the typical American, very entrepreneur, very dynamic. And it was a very good idea to debate because we are discovering things, and all of us at the world level, we have to stay tuned and we have to keep discussing, exchanging, because unfortunately for us, it's not the end of this crisis. And after this crisis, we have the other one. We have the climate challenge, which is always there. Again, Walter, Emmanuel, Max, and Jeff, thank you. Dave Williams and the Deputy of Dave for Digital Affairs, Rebecca, many thanks. Take care of you, take care of the ones you love.
Thank you.
Good luck.
Thank you. Thank you, Jean-Michel. IAEE wishes to thank you and our distinguished panelists for just an outstanding webinar. I know personally myself, I have learned quite a bit, and we're very grateful for your time and your expertise. For everyone listening, this webinar will be archived and posted on our website for future download, should you wish, and to share with your friends and colleagues. One last word, if you're not already a member of the IAEE, we welcome you to join by visiting our website at www.iaee.org. Thank you all for attending, and now I officially close this webinar.